Imagine that your bank statements become your strongest proof that you deserve a home loan, not your tax returns, not your W-2s. Your cash flow, finally recognized for what it truly is. Proof of your success and your ticket to the keys of your next home. What if I told you this isn't some future fantasy? It's already available. And it could break down the barriers between being self-employed and being a homeowner. That's the promise and the power of the bank statement loan. And today, I'm going to walk you through exactly how it works, whether it's right for you, and how to make it work in your favor. Hi, my name is Kevin Martini, and welcome to episode 228 of the Martini Mortgage Podcast, the power of a bank statement loan. Now, before I start mixing up this cocktail, I need to make the legal people happy. So I am Kevin Martini, a certified mortgage advisor and producing branch manager, NMLS 143962, with the Martini Mortgage Group at Gold Star Mortgage Financial Group Corporation, NMLS 3446, Equal Housing Lender. This podcast exists to inform, educate, and empower, not to provide legal or tax advice. Now, do you run a business, a freelance? Maybe you've built a smart side hustle that lets you write off all of the expenses. On paper, that can make you look broke. To a traditional lender, those deductions are red flags, not financial strategy. They see small profits. I see someone managing their business like a pro. The truth is this: the old mortgage system wasn't built for you. It was built for W-2 employees with predictable paychecks. But entrepreneurs, consultants, and gig workers, you live in a world of deposits, not deductions. That's where the bank statement loan enters, like a secret door past the income verification maze they built. Instead of judging you by your IRS numbers, this loan looks at your actual cash flow, your deposits, your consistency, your reserves. With a bank statement loan through the Martini Mortgage Group, we review 12 to 24 months of your personal and business bank statements. That lets us calculate your real income based on deposits, not deductions. This solution falls under what's called a non-QM or a non-qualified mortgage. That simply means it doesn't follow the rigid, one-size-fits-all rules that require a W-2 and tax returns. So if your bookkeeper made smart deductions, if your revenue fluctuates, or if your side gigs doesn't fit neatly into a spreadsheet, this levels the playing field. Now, like every tool, it's not perfect. You'll still need good credit, some reserves, and a solid down payment. And yes, the cost might be a little higher, but often that little higher is the difference between owning a home and being told no. The number one question I get as a certified mortgage advisor is very simple. How much can I afford? With a bank statement loan, here's how we figure it out step by step. Step one, average deposits. We look at 12 to 24 months of statements. Total of qualifying deposits. Divided by the numbers of months to find out your average monthly income. Then we apply something called an expense factor, usually between 15 and 50%, depending on your business type. Whatever remains becomes your qualifying income. So step one was averaging your deposit. Step two is credit scores and reserves. So in step 2 with your credit score, it's going to need to be 660 or higher, and you're going to need between 6 and 12 months of mortgage payments in reserves. Step 3 is down payment and loan to value. This is not a 3% down home loan. Most programs need around 20% down, though there are some niche options stretching to 90% loan to value for some very strong profiles. Step 4, interest rate. Because you're asking the end investor to take a little bit more risk because there's no W-2s and no tax returns. You'll pay a slightly higher interest rate, but slightly higher is far better than being locked out completely. Now, there's some, step 5 is some underwriting safeguards. Think of these as guardrails, not roadblocks. Your CPA may need to verify your business and expense structure. We'll clarify which accounts, business or personal, to use. Maybe we'll use both. Large or unusual deposits like crypto, transfers, or gifts are excluded from the actual calculation. When your income is calculated from the statement instead of tax math, you often gain more buying power, especially if your taxes have strategically minimized your profit. Now, is a bank statement right for you? Let's find out. Is it a good fit if you're self-employed, 1099, or a gig worker? And it's a great fit if your tax returns do not reflect your real income. And it's a great fit if you have 12 to 24 months of deposit history, along with a solid credit of 660 plus and decent reserves. And finally, it's a good fit if you can put 20% down. Now listen, be cautious if there's some big income swings or you're light on reserves or your deposit history is very messy and commingled with personal funds. But if this sounds like you, don't worry, you can prepare. Clean up those accounts, consolidate income sources, build a few months of reserves. With the right plan, this becomes a strategic path to home ownership. Let me share a real-world example, and let's keep the client anonymous. So this, say I had a client who was a graphic designer and a consultant. His tax returns showed $60,000 a year after deductions, but his actual deposits were over 24 months, average $120,000. When he applied with one of those big box lenders, they wanted W-2s and audited returns. And after they put him through the ringer, they said no. When he came to me, I reviewed the 24 months of business and personal statements, applied a 35% ratio, and his qualifying income came out to be $6,500 a month. With that, he qualified for a $450,000 home in Raleigh, North Carolina, right in the neighborhood he'd been dreaming about. Yes, the interest rate was a bit higher than a conventional loan, but that slight difference was nothing compared to the cost of being shut out internally. The result? My client got his home. He didn't have to inflate his taxes or rebuild a business structure. He simply let his real cash flow tell the truth. That's the power of the bank statement loan. So let me clear up some of the biggest misconceptions. Aren't non-QM loans predatory? Well, let's be transparent. Some are. But many smart, well underwritten solutions for modern borrowers. The key is transparency. And that's what you get here with me, Kevin Martini. Aren't interest rates sky high? Not necessarily. Yes, they're usually a little bit higher, often within 0.5% to 1% of a conventional loan. Depends, of course, on your credit and your reserves. What if 1 month of deposits is off? Well, if that's the case, know that I use a common sense approach. We look at trends, not the outliner, because life is imperfect and your mortgage shouldn't demand perfection. Then I hear, will it hurt me when I refi or sell? And the answer is not at all. Once you own a home, you can refinance later into a conventional loan if your income picture changes. Equity is always equity. And then one of the misconceptions, are these loans too nichey? Not anymore. The bank statement loan with the Martini Mortgage Group is one of the many strategic mortgage options we use every month to help families become homeowners. Now, if you're nodding right now, maybe realizing you've been boxed out by an outdated system, this could be your way in. A way to hold real estate, to build wealth, to break free from the tax return trap. Because at the end of the day, your cash flow is your voice, and it's saying you deserve this. If you want clarity on your exact numbers, or if you're simply wondering whether a bank statement is your best next step, let's connect. I'll personally review your scenario confidentially and completely complimentary. You can reach me by dialing 919-238-4934 because clarity creates certainty and certainty creates power. I'm Kevin Martini, and thank you for tuning in to this special episode of the Martini Mortgage Podcast. This is where we mix facts, strategy, and clarity to help you make confident real estate and mortgage decisions. Until next time, stay clear, stay confident, and remember, the right strategy beats the best rate every time.